Um, Imagine looking at a company's financial report, seeing that they intentionally lost 60,000 active subscribers in a single year, and then hearing their leadership confidently declare that it was the absolute best move they could possibly make.
Right. I mean, it sounds completely counterintuitive. It goes against, well, everything we are taught to look for in a modern tech or media business. User growth is supposedly the ultimate metric, you know?
Exactly. You see a subscriber drop like that, and you just assume the ship is sinking. But today, we are looking at a legacy media giant that is actively throwing passengers off the boat to make it go faster. So welcome, and thank you so much for coming to watch the video today.
Yeah, we are really excited to have you with us. We're getting into Getty Images Q1 2026 earnings call.
Okay, let's unpack this, because this massive historic archive is navigating like a totally chaotic landscape. AI is flooding the internet, algorithms are shifting, and they have this huge pending mega merger. So first, let's summarize the company's prepared presentation before we get into the Q&A session.
Sounds good. So the presentation started with the financials, and the headline numbers looked a bit rough at first glance. They reported Q1 revenue of $226.6 million.
Which is technically up 1.1% on a reported basis, right?
Right, but if you factor in currency fluctuations, it's actually down 2.5%. And their adjusted EBITDA, which is basically their cash profit, came in at $61.6 million.
So that means their profit margins dropped to 27.2%, down from 31.3% last year.
Exactly. But, and this is a big but, they maintained their full-year guidance. They told investors to still expect revenue between $948 and $988 million by year-end, with margins bouncing back up to 30%.
Which is a bold claim. Strategically, the presentation also highlighted a massive subscriber drop. They discontinued their iStock free trial program in June 2025.
Yeah, and that brought their active annual subscribers down from 318,000 to 258,000. They also noted that their agency segment is really shrinking. It's less than 15% of total revenue now, down 14% year over year.
Mainly because of AI tools eating that low-end market. But on the bright side, they mentioned their editorial revenue was up 11% and corporate revenue grew 6%.
Mostly driven by huge events like the Winter Olympics. They also briefly touched on their balance sheet, which has a staggering $1.99 billion in debt, and of course the pending Shutterstock merger, which is currently stuck waiting on UK regulators.
Okay, so that's the high-level summary of the presentation. Let's dive right into the analyst Q&A session.
Yeah, the Q&A was fascinating. The first question came from Ronald Jose at Citi.
Right, and he basically asked about the team's confidence in maintaining that full-year guidance. I mean, starting the first quarter in a hole makes hitting those year-end targets seem like a massive uphill battle.
It really does. But CFO Jennifer Leiden took this question, and she gave an answer that is basically a masterclass in accounting illusions.
Oh, right, the ASC 606 rule.
Exactly. Leiden explained that the revenue decline wasn't an operational failure. It's just a quirk of how large enterprise deals are recorded under these ASC 606 accounting rules.
For those of you listening who aren't CPAs, what does that actually mean?
Well, and in Q4 of 2025, Getty signed 2 exceptionally large multi-year licensing agreements. Under the rules, they couldn't just triple that revenue in month by month. They had to recognize about $40 million of it immediately in Q4.
Wait, so they essentially time-traveled millions of dollars of future revenue into the past?
Yes, exactly. It made Q4 look artificially huge and Q1 look terrible by comparison. Leiden said without that time travel effect, their core business growth is actually quite solid.
I mean, that's like prepaying your apartment rent for an entire year up front and then complaining to your friends the next month that your bank account is totally empty.
That is a perfect analogy. You aren't poor, the timing just distorts your cash flow on paper.
Okay, moving on to the next analyst.
Yeah.
We had Mark Zgudovich from Benchmark.
Yeah, and Mark had a multi-part question. He asked about premium access net dollar retention, he asked about right-sizing the agency support team, and he questioned their willingness to sign AI licensing deals.
So let's break down the company's response, starting with that retention piece, because losing 60,000 subscribers seems terrible.
Right, but Leiden and CEO Craig Peters explained that dropping those free trials was how they fixed their metrics. Those free trial users had a renewal rate below 10%.
So like 90% of them churned out immediately, just total dead weight.
Exactly. And what's fascinating here is that by shedding that dead weight, their underlying metrics shine. Their premium access tier, which is their top enterprise sub, sits at a perfect 100% retention.
Wow. So they aren't losing a single dollar of value from that specific customer cohort year over year.
Nope. and Unsplash Plus is over 90% too. As for the agency side of his question, they confirmed they did small layoffs in Q1 to match the declining transaction volume there.
Which makes sense since AI is destroying that bottom-tier generic stock photo market, which leads directly to his question about AI licensing.
Right, and Peters was very clear here. Their AI licensing revenue was actually quite low in Q1 by design. They aren't just dumping their historic archive into a training vat for a quick cash grab.
Here's where it gets really interesting. They are focusing on deep integration into large language models, right? Like Perplexity.
Yeah, they want to provide historical accuracy and context. They don't want to just be anonymous training data. And Peters noted that their custom AI sets, where they build safe AI tools for corporate clients, are actually up 250%.
So AI is actively killing their low-end microstock business, but simultaneously creating a brand new premium product for them on the enterprise side. It's wild.
It really is an incredible pivot. Okay, so the next question in the queue came again from Ronald Josie at Citi.
Right. And he asked about the revenue split. He noticed that the creative business looked like it was dropping, while the editorial business was soaring.
Yeah, and CFO Jennifer Leiden stepped in to answer this one too. She explained that it all comes down to customer behavior during major events like the Milan Cortina Winter Olympics.
Because real-world events require a scale and reality that AI just can't fake.
Exactly. Leiden said that during the Olympics, those high-end premium access customers naturally shift their daily downloading behavior. They stop downloading generic creative stock photos, and they start pulling thousands of real-time editorial shots.
So they aren't spending less money, they're just pulling from a different bucket.
Right. Leiden said this created a 380 basis point drag on their creative revenue, but a massive 620 basis point lift for editorial.
That makes total sense. I mean, when AI can fake a picture of anything instantly,
Yeah.
verifiable truth suddenly transforms into a luxury good.
It's the one asset that cannot be generated by a text prompt.
Okay, the final big topic from the Q&A was the Shutterstock merger. Ronald Josie brought this up as well, asking about the regulatory timeline.
Yeah, and this is where Craig Peters sounded visibly frustrated. He explained that this roughly $2 billion mega merger has unconditional clearance everywhere in the world, except the UK.
Right, the UK's CMA review is dragging on until June 14th, 2026.
And Peters pointed out the sheer absurdity of it. The entire global deal is paralyzed over a hyper-specific segment of the UK market that represents only £3.5 million in revenue.
It's crazy. And honestly, you have to wonder how long they can sustain this friction. I mean, Leighton mentioned earlier that they've been burdened by nearly $115 million in one-time cash expenses recently.
Yeah, from merger costs, AI litigation, paying off judgments, they even had to draw $120 million on their revolver credit to pay a court judgment.
So they're carrying this beautiful cash-generating editorial business inside a highly leveraged corporate shell.
Leiden assured the analysts that the worst of those one-time cash drains are largely behind them, but the debt is definitely heavy. They really need this merger resolved to remove that overhang.
Okay, so what does this all mean? Let's do a high-level wrap-up of the main themes from the presentation and the Q&A.
I think the biggest takeaway is that Getty is a company of paradoxes right now. They look like they missed revenue expectations, but it was really just an ASC 606 accounting quirk.
Right. And they lost a massive amount of subscribers. But it was a deliberate move to purge unprofitable free trials and save their margins.
Exactly. And the most striking paradox AI is devastating their bottom-tier generic image business, but it's making their top-tier live editorial events more valuable than ever before.
They are strategically shrinking their footprint in the cheap stuff to fortify their position as the purveyors of verified truth.
It's a bold structural bet on reality.
It really is. Well, thank you all so much for coming to watch the video today. If you like this breakdown, please click like, share the video, subscribe, and stay tuned for upcoming content.
Yeah, we really appreciate you spending your time with us.
I'll leave you with one final provocative thought to mull over on your own. As generative AI makes it infinitely cheap and effortless to create a synthetic image of literally anything imaginable, does the purely human act of simply being there, standing on the sidelines of a World Cup match with a camera in the freezing rain become the most valuable commodity in the media world? Will we eventually pay a premium, not for the aesthetic beauty of an image, but strictly for its verified humanity? Think about it. We'll catch you next time.